This morning in Seoul, we are delighted to have Global Group with us. He's a former New York Fed president and also Princeton University senior research scholar. Please welcome Mr. 윌리엄 Dudley. Nice to see you. Thank you for joining us today.
Great to be here.
How do you expect that the Fed big step to be developed, and what is the expected base rate for the end of this year?
Well, obviously, nobody knows for sure because it depends on how the economy evolves and how markets react to the Fed's tightening. But I think the Fed is a very strong mind right now to move rates up pretty sharply over the next 6 months, probably to around 2.5%. That's a pretty close estimate of what they see as neutral, a monetary policy that's neither easy or tight. And because the labor market in the United States is very tight and inflation is quite high, they want to get to neutral very quickly. So it takes some unusual events from here to push them off that path.
You predicted that the recession is inevitable due to Fed efforts to control inflation and will occur in 2023 or 2024. You also warned that if a recession does not occur, it puts the U.S. economy at greater risk. Fed President James Bullard said a recession is premature. He explained that the Fed will try to catch inflation without a recession. What are your thoughts on this? What amount of recession would concern you?
Well, of course, the Fed's going to try to avoid a recession. The problem, though, is that when the Fed has found themselves in the current circumstance that we are today, with a labor market that's too tight, the Fed has never been able to tighten monetary policy, push up the unemployment rate, and not have a recession. Chair Powell, in his comments recently, talked about 3 episodes where the Federal Reserve tightened monetary policy and a recession was avoided: 1965-66, 1984-85, and 1994-95. The problem is none of those episodes are relevant to the current set of circumstances. In all 3 of those cases, the unemployment rate continued to decline. The unemployment in the US is already 3.6%, below where the Fed thinks full employment is. So the Federal Reserve has to tighten monetary policy enough to slow the economy down so the unemployment rate moves up. The problem is whenever the unemployment rate moves up more than marginally, the next stop is a full-blown recession. Now, I agree with Jim Bullard that recession is not likely in the near term. The economy has considerable forward momentum. Household balance sheets are in excellent shape. There's a lot of demand that has not been satisfied recently because of the supply disruptions. So, for example, in the motor vehicle sector, the demand exceeds supply. And so even if the Fed restrains supply a bit, demand a bit, you're still going to see increases in output as supply chains normalize. The key issue here is not the headline rate of inflation. The headline rate of inflation is going to come down over the next year as some of the transitory factors like big increases in used car prices reverse. The problem is the labor market's too tight. Chair Powell even called it unhealthy degree of tightness, which is a hard thing for Fed officials to say because talking about too many people being unemployed is not something that the Federal Reserve wants to sort of admit to or underscore. The problem is that the Fed tightened monetary policy too late. And because they responded too slowly, the labor market got to a point where it was sufficiently tight that it's likely to put further upward pressure on wages. And that's the thing that's going to drive ongoing inflation.
Mike Wilson, CIO of Morgan Stanley, warned of sluggish earnings, saying given the numerous cost pressure facing businesses, the earning outlook for this year is too optimistic. Do you think inflationary pressure will backfire on corporate earning growth? Morgan Stanley also predicted that the S&P 500 could drop to 4,000 this year. Will the stock market turn downward this year?
Well, you asked me a few questions there. So in terms of the earnings outlook for U.S. corporates, I think it's still okay because the economy still has a considerable forward momentum. And in a lot of sectors, the demand exceeds supply. That said, we are in a economic environment now where there's a shortage of labor. So that limits how fast the economy can grow, number one. Number two, when labor is in short supply, usually what happens is profit margins get squeezed as businesses are forced to compete for that scarce labor. So I think we're certainly going to see a significant slowdown in earnings growth in the year ahead. In terms of the stock market, I think the stock market is probably going to struggle. Number one, earnings growth is going to slow. Number two, the Fed is tightening monetary policy. And number three, the risk of recession, not this year, but in 23 and 24 is increasing. I think all those things are going to weigh on the stock market. When the Chair Powell was very clear to market participants not too long ago, he said financial conditions have to be tightened. That's how monetary policy works. It works through financial conditions. Well, what makes up financial conditions? The bond market, the stock market, the dollar, the valuation of the dollar. And so we're probably going to see some combination of those three things: higher bond yields, weaker stock prices, firmer dollar. And so far, all three things are playing out. So the good news from the Fed's perspective is they're finally getting a little bit of traction. They wanted to tighten financial conditions. They're now managing to do that to some degree. And so that's good, because that means the monetary policy shift is starting to have consequences.
In this low growth era, which sectors should be noted as industries that are strong in crisis?
Well, I mean, I think that, we're late cycle. So you want to start to think about areas of the stock market that are less cyclical. So consumer non-durables, for example, healthcare, for example, things that people are going to buy regardless, whether times are good or whether times are bad. And I think you have seen a rotation out of growth stocks towards these kind of sectors. So that's, a little bit more defensive posture in terms of equity investing is probably warranted now. I think the problem that people have right now is, the economic recovery isn't that old because, the pandemic hit in the spring of 2020. The economy fell very, very sharply and then began to recover. So the recovery isn't very old, but we're in the late cycle of and so. We've been used to these very long business expansions in the United States, 1990 to 2000, 2001 to 2008, 2009 to 2020. But this is going to be a pretty short business cycle because the last cycle, which is interrupted by the COVID pandemic. So we're in a situation like we are, within a year or two of the end of the business cycle, not like at the beginning of the business cycle.
What advice would you give to an investment portfolio for individual investors?
Well, the first thing I would say is you need to invest for the long term. So make your investments, put it away, and don't react to near-term news. If you had sold everything in 2008, 2009, you would have missed a big recovery in the stock market subsequent to that. The best thing to do is stay invested. The best thing is to rebalance. When the stock market goes up a lot, take a few chips off the table, rebalance your portfolio. And lastly, don't chase fads. Don't chase fads. There's always a hot part of the market that people get attracted to. The problem for the average investor, though, they enter that hot area late rather than early. And so usually when the bubble bursts, and we're sort of seeing a little bit of that bubble bursting in the U.S. tech sector right now, they don't get all the gains, but they get all the losses. But the big thing is to be a long-term investor with a balanced portfolio. If you do that, my own personal, investing strategy is to hold broad-based ETFs and just hold them as a core part of my portfolio, and don't worry about it when the stock market goes up or down. And occasionally rebalance.
I think we cover a lot. Thanks once again for sharing your insight with us.
Okay, well, thank you very much. It's been a pleasure.